Okay, recording's beginning. Good morning and welcome to another edition of the Nerd Enterprises Incorporated webcast. This is another special webcast we're bringing to you specifically on QuickBooks and how we use the balance sheet in QuickBooks as our checklist when consulting with a client. Before I get into that, though, I've got to get some of the promotional stuff out of the way. We are holding a webinar for QuickBooks experts or QuickBooks pros and talking about how to take things to the next level. In fact, that's why I chose this topic today, because the webinar is coming up on August 1st, and it's going to cover a lot of the same type of material that I'm going to cover in a few minutes in this webcast, but obviously in much greater depth. And it's designed to take people who use QuickBooks and who understand bookkeeping and show them how to really take things to the next level and really get an understanding of how the financial statements relate to one another, where your debits and credits are going, how they're affecting the different financial statements, and what it really all means. So bear with us and tune in. If you click on this slide that I've shown right here, then it'll take you right into the shopping cart of our website where you can register for the webinar. So go ahead and click on this if you're watching the recording after the fact, and it'll take you into the shopping cart. You can download a brochure or watch a brief 2-minute presentation which goes over in a little bit of detail what this webcast is going to be about. Without further ado, I'm going to get into today's webcast on how to use the balance sheet as your checklist when you're reviewing a set of books. And with that, as always, I'm going to bring the screen up to a full-size screen so you can see very clearly. In a second, you'll see on your screen the actual product in our shopping cart for the webinar that I was just talking about. I had it up here so I could copy the hyperlink in and set it up in that image in the slide. And we'll get back to that image at the end of this webcast. But very quickly, because I only have a few minutes for a brief webcast, I want to take you over to a sample company file, balance sheet, dated December 15th, 2012. And very quickly, I'm going to show you and demonstrate how these transactions or how these accounts relate. Pretty much anything that you do in a business at some point and in some way, shape, or form is going to affect the balance sheet. No matter what it is, any transaction you enter into. And I'll offer a challenge, we'll put it on the QuickBooks blog. If you can come up with a transaction that takes place in a company that doesn't eventually affect the balance sheet in some way, shape, or form, if you can stump me on this, I'll give you a free 1.5-hour training session, which is a value of $150. And it'll look just like this, except it'll be you and me live going over whatever you want to go over in QuickBooks or Excel or anything else that we teach. And I'll give you that hour and a half for free. We'll record the whole thing so you'll get a recording that looks just like this of our live session at the end of the session. But very quickly, the simple explanation for what I'm trying to describe is, let's say 85% of the things that we pay for in a business, 85% of the expenses are going to be paid for by simply writing a check. Whether we've entered a bill first and paid it later, eventually I'm going to write a check. And that's, of course, how 90% of what most businesses do are going to affect the balance sheet right away, because you're going to at some point write a check which is going to affect your cash accounts. Now, as an auditor, when we would audit companies' financial statements, we would have detailed checklists to go through, but the simple explanation of the formula that we would apply in auditing a set of financial statements would be that we would go through each account on the balance sheet, and by beating up the balance sheet, so to speak, we would effectively have hit just about every area, if not every area, of the profit and loss statement. And the reason why is most of your expenses, which is most of your profit and loss, are going to be affected in terms of writing a check, which affects your balance sheet accounts, your checking, your cash accounts. The next thing, of course, is looking at accounts receivable. Now, this is an account on the balance sheet that directly ties into your income. I post an invoice, it's going to post to accounts receivable. So by going through the accounts receivable account and looking at what's in there, looking at what's been in there throughout a period of time, I can get a sense for what the income should look like. And again, I'm looking at something that directly ties into income-related accounts. These are prepaids. These are also things that tie in directly to an expense. What it means is I've paid for an expense ahead of time. And when we do a set of books on an accrual basis, what it means is I don't want to recognize the expense until the benefit has actually been derived. So if I pay up front for a whole year's worth of insurance, the true proper accounting method for that is to say, all of it's prepaid except for 1 month, and then each month I expense out a proportionate piece of what I had prepaid. This way I'm recognizing the expense in the appropriate period. So again, prepaids are going to tie directly into an expense at some point. Prepaid insurance is going to tie into my insurance expense. Employee advances may never affect the profit and loss, depending on the nature of it. If I advance an employee money that they then use to purchase things on behalf of the business, and later they submit an expense report for travel or meals and whatnot, then it will directly affect the profit and loss. So it doesn't go both ways. What I do on the balance sheet won't necessarily affect the P&L, but everything I do on the profit and loss statement will eventually affect the balance sheet. And I'm going to get to the last illustration of this. Like I said, on August 1st, we'll go into much more detail on this. But when I enter a bill, it's in accounts payable, that hits an expense. So accounts payable directly ties into an expense. And then it's going to get paid for, as I mentioned, most likely with a check. But the other way I might pay for something is with a credit card. So a credit card, again, represents a liability. It's money I owe to the credit card company, and it directly ties into an expense that I've paid for. I have, in a sense, just delayed payment. So if I pay the electric bill, let's say, with a credit card, then what it means is the electric company might have given me 30 days from the billing date to pay it. Now I've paid that with a credit card. The credit card gives me another 30 days. So all I've done at that point is shift the liability. I've taken it essentially out of accounts payable and put it into a credit card payable. So that being said, what I'm able to do is I'm able to recognize when I go through this balance sheet what the impact is and how it relates to the profit and loss. And of course, the very last thing I'll touch on very quickly, this gets into an area that's somewhat complex and not a lot of people understand it real well in my experience, is let's say it's a small company, the owner of the company pays for something out of pocket. He takes money out of his own pocket or uses his personal credit card to pay for something. Well, ultimately, that's going to affect one of two places on the balance sheet. Either we're going to deal with it through equity and say he made a contribution into the business by paying for an expense on the business's behalf, or we're going to put it up somewhere down here in the liability section where we say the company now owes the owner. It's going to be a shareholder loan. We're going to say the shareholder loan money to the company by paying for an expense on its behalf. That's the two ways. So that's the very quick webcast version of what we're going to be going over in much greater detail on August 1st. Now we do have a visitor in here, and I've got time for one quick question. Penny, if you've got a question, now's the time. Looks like Penny's gone. So we will post this recording up very shortly. You can click on here as I mentioned, and you will get linked right into the shopping cart where you can sign up for our webinar on August 1st. Thanks for joining.